Hi, today we are talking about some key concepts of business transaction. There are some key concepts we conclude in chapter 2, and we have 思源入 5193 and 国语算 5222.
I'm Seal. My student ID is 5193. In accounting, the business transaction is an event that must be measurable in terms of money and that essentially impact its financial position of the business. Characteristic of a business transaction from above discussion, we can point out the following 5 important characteristics of a lead business transaction that every bookkeeper of accountants must take care of before entering the transaction in the journal. First one about it is a monetary event. The about it affects the financial position of the business. Third is it belongs to business, not to the owner or any other person managing the business. Third is it is initiated by a trust person. The one about it is supported by a source document. Next point about types of business transactions. In accounting, the transaction may be classified as first is a cash transaction and a credit transaction. The second is internal transactions and external transactions. Internal transactions are those transactions in which no external parties are involved. These transactions don't involve in the exchange of values between two, but the event triggered the transaction is in real terms and impacts the financial position of the business. Examples of such transaction including recording, creation of fixed assets, and realizing the loss of assets caused by fire. External transition are transition in which a business exchange with external parties. Only a transaction other than no transaction are external transaction. These are the transactions that a business performs on daily basis. Example of external transaction include purchase of goods from sale of goods to customers, purchase of fixed assets for business use, payment of rent to owner, payment of gas, electricity or water bills, payment of to employees. Normally, a large of the transaction performed by any business sets of external transaction. It's my part over. Thank you.
And this is Yuna speaking. As accounting is aimed to better recording and analyze business transactions, we always have balance sheet, statement, and income statement, which is very important. In balance sheet, it has asset, liability, and equity. As the liability is not owned by the owner, the liability is always negative. In income statement, we have revenue, expense, and net income. And the net income will move to the equity account of the of the balance sheet in every fiscal year. And it's important to recognize different accounts. Accounts are generally divided into assets, liability, and owner's equity. For example, in an asset account, we can always see cash, note receivable, account receivable, accrued interest receivable, marketable securities, inventory of merchandise, office supplies, operating equipment, prepaid expense, investment, property and equipment, and other assets. And in liability account, we can see note payable, account payable, tax charged to guests and withheld from employees, income tax payable, accrued expense, and earned income and mortgage payable. And in owner's equity account, we can have capital account, revenue account, and expense account. With the big three statement, the financial statement seems not so complex. Many big companies all over the world, such as Apple, Amazon, all use the same thing, and we can see the Apple as an example. These are the financial statement I researched in the Apple's website. And another important point in this chapter is the relationship between assets, liability, and equity. And these things always influence each other. Like the assets are increased by debit, liabilities and owner's equity are increased by credits, revenue are increased by credits, and expense are increased by debit.